Hi guys. Wow, I hope the camera looks a bit rough actually. The camera. I hope you can see me okay. Um, the picture's not ideal. I probably need to get a better camera lens going forward. Okay, so this is going to be the first live stream that we're doing. Hopefully, we'll be able to get a bit more professional. As I said, the camera to me looks a bit dodgy. So anyone who wants to comment and just see what we're doing regarding, they can actually see the video and it's good quality. Tell me if it's not, then we're going to have to just suffer this as a trial because I haven't done a live before. This is the first time. You have to remember, I'm not a media guy. Okay, I'm just giving comments on financial markets. So anything to do with technicalities, it's just I've got to learn as we go along. So some of the stuff that I do in the morning, for example, the driving markets, it's just done off the cuff. It's just done as I'm driving. Then I talk about financial markets and just regurgitate everything that's going on within the sectors and hopefully give you as much information as possible. All right. So anyone who's looking to join, then great. Okay. What's this here? Say something. I don't know what that is. Okay, right. So if you have any questions or answers along the way, then you can just answer them. Again, this is more or less the first time that I've done a live stream. We'll see who joins, who doesn't join, etc., etc. And let's kick off. Okay, so what the idea is around the live stream is to give you some interaction on financial markets. Okay, the idea is to develop an audience and hopefully the audience will benefit from any type of knowledge or experience I've got over the last 25, 30 years when it comes to financial markets. Okay, so financial markets overall, as you're well aware, is a huge subject and it's divided into sectors. And it's going to be very hard in one stream to discuss every sector. So what I'd like to do maybe is probably cut it down as each live stream into that particular sector. And overall, what I'd really plan to do is give you a macro picture, okay, on fundamentals. So it'd be very difficult to discuss micro because if we discuss micro, then we're going to pick one particular asset class and then dig down. Probably at a later stage, we could do that. That all depends on what you want as an audience. But generally speaking, I'd like to give a macro picture and a fundamentals overall on how financial markets work and what really gets them going, what's driving those markets behind the scenes as such. So if we were to kick off and say the financial markets is really governed by the bond market, I know you're going to be surprised to hear that because most people are either investing or trading in shares or trading in FX, Forex, or recently in the last few years trading in cryptos. But the real driver behind financial markets is the bond market, or another word for the bond market is the debt market. Okay, so the bond market is where companies and governments go to arrange money and get actual finance. Without the bond market, there'd be no equity market. Okay, so the basis of all financial markets is the bond market. Okay, hopefully that is. Hopefully you're all okay, can see that. Okay, so the bond market is managed by all capital markets by banks. All right. So let's say a company, let's call it, let's say Apple, okay, or IBM, or Microsoft, or um, BP, Shell, want to raise money. So what they do is they go into the bond market and they go and borrow money at a fixed amount. Okay. So they go and borrow 50 million, 100 million, 200 million, 500 million, and they issue a bond. And they issue that bond over, say, a period of normally it's 5 years or 10 years. And attached to that bond, they'll give a coupon. A coupon is another name for a dividend or interest. Okay. So if you buy into that bond, then you will get an interest payment every 6 months or every year from that company. So say, let's take a big company that everyone's aware of. Let's call Apple. So Apple want to raise money. Now, why would Apple want to raise money? Apple's not a particularly good example, but since I've chosen it, we're going to dig down into Apple. Why would Apple issue a bond when they've got loads of money? It's quite simple. When they borrow money, they can offset that borrowing against the tax. So it becomes tax efficient for them to borrow money, pay interest, or then use their own capital to invest in their own business. Okay, that's just a little bit background on that particular issue. But let's say, let's call any company, a company that's in trouble, ABC. Okay, ABC needs to borrow some money, and they go to the market, say, right, we want to borrow $100 million, and on that we're going to pay 3% a year. But actually, today wouldn't be very good because you get 3% in the bank. So we're going to pay 5% a year. Okay, so whoever holds that bond is going to get 5% return, a 5% interest payment on that particular bond every year for as long as they hold it. And at the end of the period of the bond, whether it's 5 years or 10 years or 15 years, they go to their bank and they redeem that bond. Okay. Now, when you invest your money on or buy that particular bond, you're giving your $10,000, your $100,000. The $100,000 will end up with ABC. ABC will take the $100,000. However, in order for ABC to get the money, there has to be a structure, a framework for that bond to be issued on the market. Now, who does that? Okay, how is the bond issued? How's it launched? How's it printed on the market? Okay, so what happens is ABC goes to their bank, goes to their corporate bank, and they say we want to borrow $100 million, and then the bank say Goldman Sachs or JP Morgan, Morgan Stanley, Daiwa, Nikko, Chase, Merrill Lynch, Bank of America, I can name them, and Barclays. They say, right, we'll do the job for you. We'll take responsibility for getting that bond launched. Okay, great. So now let's say Goldman Sachs has taken the bond. They now have got their client as ABC, and they've now got to issue $100 million bond. What they do is they take the $100 million bond, and they are called the lead underwriter. Okay, they take responsibility for getting the $100 million to ABC. Now, in this particular case, Goldman Sachs don't want to take all the risk of the $100 million. So what they do is they begin to sell that risk to other banks, and those are called co-underwriters. Okay, so they take the $100 million and they say, listen, buddy, we don't want to take the $100 million risk. What we want to do is we'll take part of that risk, but would you take part of that risk? So they go to the other banks and they sell that risk. So they go and sell it to JP Morgan, Morgan Stanley, Merrill Lynch, Bank of America, whatever the case may be, and they go and sell that risk. So each one of those banks say, you know what, we'll take 5 million, we'll take 10 million, we'll take 20 million of that risk. Now, once the banks have closed that particular 100 million, so it's now been spread amongst the banks, they then go and sell their risk, their bond to their customers. Okay. So they take the bond and they go and call up Mr. Joe Bloggs, who's a client of Chase or client of Merrill Lynch, and they say, hey, we've got this great bond being issued by ABC. They're paying 5% a year. Would you like some of it? Say, yeah, no problem. What's the minimum investment? And they say, minimum investment is $10,000. He said, no problem. Take $50,000. I'll take the bond for 10 years and I'll get 5% a year. So Mr. Joe Bloggs signs the forms down at his local branch, invests $50,000, and he gets 5% a year. And the banks will sell those bonds to all types of individuals, hedge funds, insurance companies, managed funds, mutual funds. Any type of fund manager will take a bond and say, you know what, we're going to get guaranteed 5% a year. That's great. Now, that's only if ABC is a good quality company, good quality business. Okay. So then you have to look at the rating of ABC. So you have to look and say, okay, what is the rating of ABC? Does ABC have a good rating? Is it AAA? Is it AA? Is it A plus? Is it triple B? Is it double B? Based on the rating of the company, then the price of the bond and the interest rate that you receive, the coupon, will be determined. Okay, so the lower the risk of the company, for example, if you were to take a bond, as I said earlier on, of Apple, and you were to take a bond of Driving Markets, then Driving Markets has a maybe a triple D minus rating. It's absolutely crap. It's called junk. And Apple has top rating. So the interest that drivingmarkets.com would have to pay on the bond to get the money would have to be around about 12% or 13% to attract buyers in. And the interest that Apple has to pay is 2 or 3% or 4% because their rating is so good, your money's secure. So just talking about those particular aspects, I'm diverging a little bit, but as I'm thinking and I'm dynamic, well, let's just move into that sector a little bit. So in the bond market, um, you've got bonds that are based on the quality of the company that's issuing the bond. So the stronger the quality of the company issuing the bond, then the interest rate will be lower. They won't need to give a high interest rate. However, if the quality of the company issuing the bond is trash, or they call it junk, then the interest rate is going to have to be a lot higher in order. What have I just said? Limited. Okay, in order to attract buyers. Okay, so if the trash or junk bond is so junk for an investor to take the risk, what they're going to have to do is they're going to have to receive a higher interest rate in compensation for that bond being junk. All right. Now, some junk bonds have turned out to be unbelievable. For example, in the 1980s, you'd be surprised that Sky Television was a junk bond. Okay. Rupert Murdoch, who owns Sky, issued bonds and they were junk. They were junk status. So the interest rate that they paid on their bonds was huge because no one wanted Sky Television. Sky Television in the 1980s was an unknown. And because it was an unknown, what happened? You end up getting a situation whereby you have to pay a lot more money in order to get people to invest. You've got to pay out more interest to get them to invest. However, today Sky Television is AAA. So anyone investing a bond in Sky Television now is going to get much lower interest than they did back in the 1980s or 90s. Let's look at the questions. What is okay? So I've got a question here. Is what are the best website platforms to buy US European bonds? What is the average interest rate on a US European bonds and which companies to sell bonds? Wow. Okay. So if you're going to, just to answer that question very, very quickly, if you're going to look at bonds, first of all, start off with your particular platform. Try Interactive Investors, Interactive Brokers, or try your bank. I don't actually have a solid website where to buy and sell bonds, but normally you do it through your bank or try Interactive Investors, and I can do some research where the Joe Public yourself can go invest in bonds. So I haven't got an absolute answer for that at the moment, but I'll do some research on that just to answer that question. So Sky Television was junk bond in the 1980s. Now it's AAA. However, the risk on junk bonds is that they could end up being completely and utterly real trash and go bankrupt, and you end up losing all your money. Where on AAA bonds, what actually happens is that your money should be solid. Okay. Now, that normally should be the case. However, I don't know how old the audience is, but I need to take you back to the 2008, 2009, 2010 debt crisis. Okay, so that's just going to diverge a little bit. We're now going to go into the debt crisis, which, by the way, is the starting point of where we're at today in terms of inflation. But that's, I'm not going to go into that at the moment. Let's just concentrate on focus on what happened in 2008 in the bond market. Okay, now, excuse me. Hope you're all enjoying this. I don't hope you're not falling asleep. Okay, so in 2008, up until 2008, back in actually it's 1970s, there were assets were gathered together and made into one unit called a swap or a debt bond. Okay, a swap debt. Okay, now I'm trying to keep it as simple as possible. Those assets were gathered together and they were sold to banks or sold to insurance companies or investment companies because they got a solid return. What were those assets? Those assets effectively were mortgages. So what would happen is that they would get together a bunch of AAA mortgages. Who fails on the mortgage? No one fails on the mortgage. Everyone pays the mortgage. Everyone wants the house, and everyone wants the house to be theirs in 25, 30, 35 years' time. So everyone pays the mortgage. So in the 1970s and 80s, what they do is they took all of this mortgage book from different banks. They would buy the mortgage book and then they would sell it, a broker would sell it to a bank. These were AAA debt, was AAA debt because it was built up of lots of houses and lots of people that are paying the mortgage, and the return on um, that particular structured product was 3%, 4%, 5%, 6%, 7%, and it was great. It was absolutely great for the insurance company or investment house or mutual fund to have one of those packaged goods within their structure, and they would buy it for 100, 200, 300 million dollars, and then they'd go and pay the mortgage company, give them $300 million. So the mortgage company then had $300 million and could then sell more mortgages because it got more money coming in. That was all great for the 1970s, and that was a debt swap. That was a swap, okay? Structured package. However, the structured package became a little bit more varied and contaminated as time went on, the 1990s and 2000s. What they did is they began to add into there a little bit of bad or poorer quality debt. People that were a bit dodgy, people that couldn't have solid jobs, and their debt was not AAA, their mortgage was B plus or C plus. But if 80% of that structure was good solid debt and 20% was poor debt, who cares? They just kept on selling these packages to the banks, and the banks would sell those packages to other banks, and eventually it would go all the way down in the market. Okay. In early 2000, late 1990s, early 2000s, the banks were so hungry for business. What they used to do, or what they did, is start selling their mortgages to poorer quality individuals, till eventually the whole structured product was rotten inside with very poor quality clients, very poor product, very poor quality mortgage holders. And what happened was is that those mortgages, those people who didn't really qualify for mortgages, but it was called subprime debt. There's prime, which is the top quality individual, and then the next level below prime, which is the top quality, is called subprime, a lower quality, a lower level of debt, a low level of client. Okay, and they take that subprime debt, claim that it was AAA, but only had maybe 2 or 3% AAA. The other 97, 98% was trash. But the buyer of that bond believed Goldman Sachs, believed JP Morgan, believed Morgan Stanley, because why would they sell something that's corrupt? And what happened is those bonds, those structured products were sold onwards, and eventually the people within, the mortgage holders within that particular sector couldn't afford to pay the mortgage or stopped paying the mortgage. And what happened? The structure collapsed, and that caused the banks to collapse because the product became worthless. And that's what happened to Lehman's, Bear Stearns, and caused them to go bust. And obviously, the whole financial industry, the financial sector in 2008 just completely collapsed as a result. Most of the banks were bankrupt. Goldman Sachs, JP, Morgan Stanley, Chase, Barclays, Royal Bank of Scotland, NatWest, UK banks, French banks, German banks, the whole world was bankrupt. And the central banks of those countries had to bail out the banks and give them millions and trillions of dollars in order to survive. Okay, billions and trillions. Okay, now that is a bad bond. Okay, that is a bond that is structured. It's called a structured product, and it was trash. Going back to the bonds that we discussed earlier on, those bonds being the basis of the financial structure where companies have flow and allow them to continue flowing, etc., etc. Moving on from the bond market, okay, and hopefully a little bit of background. Moving on to equity markets. Equity markets is more or less similar to bond markets. A company wants to raise money. And what do they do? They issue shares. You then become a valued shareholder of that particular company. You get voting rights on normal shares and allows you to vote and allows you to participate and allows you to receive dividends and allows you to have growth and share in the profitability or the non-profitability of that particular business. Okay, so when you buy shares, you are a shareholder. Now, what's happened in the last 20 years, things have slightly changed. Originally, what you do is you go and buy shares in Apple or Microsoft or the banks, whatever, and you'd have to put down 100% of your money. So in order to buy the share, you'd say the share was $10. You want to buy one share, you put down $10. You got the share. That's it. Whether the share goes up or the share goes down, doesn't matter. You're holding that share. Okay, you've paid fully for that share. However, in the 1990s or late 80s, 1990s, things began to change, and the members of the public were offered a facility to leverage or margin their trading. Okay, now up until this point, margin trading. Let's just tell you what margin trading is. So margin trading is where you put down a small percentage of your money, but you get full exposure to the benefits or the losses of that particular underlying stock. Okay, so margin trading is you put down 10%, 20%, 30% as a funding deposit, a security, but it allows you to buy 100% of exposure. So, for example, let's talk about the $10 share. If we have the $10 share and you're under the old structure, you'd have to put down the full $10 in order to buy the share. However, today, you don't need to do that. In order to buy the same share, let's call it Apple, okay? In order to buy a share of Apple of $10, it's not, but let's say it's $10, you only have to put down $2. Yet you get the same value as $10. So where does the other $8 come from? If the share is $10 and you've only put down $2, who's paying for the other $8? Doesn't make sense. What's happening is the institute that you're working with or the platform you're working with, they lend you the money. They're lending you the difference. In other words, if you've put down $2 on a $10, the other $8 is called funding. It's called finance. You pay finance on that. You pay interest on that over the next year. Okay, each day you're charged with interest. Now the interest on that today would be around about I'll work it out. It's probably about 5%. So you're paying 5% a year, 5.5% a year to the platform divided by 365 days because you're not fully paying for the share. You've only paid for part of it, and they're financing you the difference. That's called margin trading. Now, if you bought one share for $10 and only put down $2, and that share goes up 100%, say it goes up to $20, you've now made $10, which only cost you $2. Okay, because you finance the other $8. By only costing you $2, you take the $2 cost versus the $20, the $10 gain. Okay, you've made 500% profit. Okay, amazing. And that's called margin trading. But what happens if the share goes down below $10? Let's say it drops to $8 or $7. Then what they do is the platform would call you up or send you a message or an email or text message that you have to finance and put more money into your account in order to support the margin. Otherwise, they'll close out the trade. So the advantage of buying a share outright, no margin call. Whatever the value of the share is, whether it's up or down, it's only a paper value until you either sell the share or until you sell the share, until you close the position. Okay, it's only paper loss until you close out. With the margin trading, it's a paper loss until you close out, but you could be called for more money to fund that particular trade if you are on margin. In other words, if the share has moved against you, whether you're long or short, then you're going to have a margin call. And that causes financial strain on the individual trader. By causing financial strain on the individual trader, sometimes they panic and they say, you know what, they don't want to pay any more money into it. And the position is closed out either automatically or you close out your position according to your financial position, financial status, and whatever your objectives are. So that's margin trading. Now, it's important to know what margin trading is because today I would say a big percentage, I don't know exactly what percentage, but a very large percentage of trading going on in financial markets is margin trading. And you need to be very, very clear of that. So in other words, on bonds, there's no margin trading unless you go onto a CFD platform and you don't really buy the bond, you're trading on the bond, okay? But if you go onto any normal trading platform, whether it's Forex, crypto, equities, commodities, it's margin trading. And when you go onto margin trading, effectively you're putting down a small percentage or a percentage of the actual purchase of that particular asset, and 76 or 78% of people lose money on trading because they don't have enough security, enough margin on their account to deal with the ups and downs of that particular asset class. Okay, so that's margin trading. Now, ideally I just wanted to do a 30-minute live. We're up to now 25 and a half minutes. So I want to take the last 5 minutes to do a quick recap of where we are in financial markets over the last week. Again, this is the first live I've done, so I'm going to totally depend on the audience to ask questions and just give me some feedback as to what they think in which direction we want to go in. But in the last week, there's been quite a lot of volatility. Equity markets are looking to go up. In other words, traders, analysts, and Wall Street are looking to find any excuse to push the market up. And the market was up or sold off, and then Netflix came out with some terrific results, and that pushed up the sectors accordingly. So they're looking for an excuse to go up, and it looks like the markets will continue rising over the next week or 2 weeks. Okay, I don't think we're going to go into a serious correction mode in the next week or 2 weeks for the beginning of the year. However, throughout the year, by the end of the year, I think we're going to be down around about 25-30%. That's my opinion of where we're going to be at by the end of 2023. And the reason behind that is because you've still got rock solid inflation, and you're going to have rock solid high interest rates, if not higher interest rates where we're at the moment. Okay, so interest rates could go a lot higher than we are at the moment, and that would push markets down overall in 2023. Going forward, I think crypto sector is going to pick up. I think Bitcoin is going to go to 25,000 to give people a bit of an idea. I've been saying this now for a while. I think 25,000 the next level it wants to get to, and then from there it'll probably be sold off again all the way back to 20,000 or 19,000. Okay, remember Bitcoin, as I said all along, is a binary bet. There's no real fundamentals to it. Those who are big bulls on cryptos believe that's going to be the new medium to purchase things over in the future. I personally don't think so, because I don't think central banks and governments would allow the cryptos and the bitcoins to take over their local national currency, because they lose control completely of where we're at. Okay, so it's again a binary. I think it's going to struggle in 2023. I don't think it's going to go to the 50, 100,000 level. Of course, I could be wrong. There is going to be continuous liquidity issues going forward for sure. You've got unemployment rising. You're going to have corporate earnings that are going to be affected, and there could be some geopolitical further expansionists by Russia. Russia's not going to come out of Ukraine. It's not going to leave Ukraine till it's actually won the war as far as Ukraine is concerned. And you could even have this year China invading Taiwan. Bit extreme, but that's my view. While Biden's in government in the US, you could have China invading Taiwan, because Biden won't do anything. It's just simply too weak. Anyhow, that brings me more or less to the end of the first live stream. I'm hoping going to get some feedback from the viewers as to what we want. We'll probably look to do it again next Saturday night. Hope we give you a bit of information. I could go on talking for another hour and a half, but I don't want to bore you to tears. Okay, so that's more or less it from me. You can also subscribe. You can catch me on TikTok and Instagram. Those are much shorter viewings, but the real content is going to come on YouTube. All right, have a good evening, and thanks for listening.